Hi everyone, my name is Piterpakulski. Today we have a final overview of rent calculator, rent financial model, business plan. Today I will be going from top to the bottom of this financial model, showing you what parameters may affect your business idea. So if you do have some business idea, so this video can create a structure in your brain of what your business idea may consist of, what blocks of inputs play part in your business idea, what you have to think about when you are planning to start the business, how can you organize your financial model. Maybe this video will be useful for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So let's start. So first of all, when you start building the financial model, business plan for your business idea, you have to create a rule for all the inputs which play part in your inside your business idea. So all inputs should be colored with one and the same color through the whole model to make you be able easily find the inputs and play with it. Because you will have to be able to play with inputs easily. People, investors, bankers, your friends, your business partners will have to be able to find the inputs in your financial model easily, very quickly, to play with this data, with creating scenarios. So all inputs should be colored with one and specific color through the whole model to make you be able to easily create scenarios, play with inputs, not to put the inputs inside formulas and so on, making mistakes. So this is very important. So that's why we assume that this color, for example, this blue color, we assign to our inputs. So these are the inputs, these are the inputs, these are the inputs. So all other cells are automated. So as you can see, there are here we can see the formulas, and here we can see just numbers. So we are playing with the data only in blue cells. So this is the first rule. Then we start, because we are discussing rent calculator, we start with rent parameters. So first of all, we assume how many square feet or how many square meters we have in our location where we're planning to start the business. Then we specify what is the price per 1 square meter or 1 square foot in your location. Then if we have a deposit that we pay to the landlord, we specify the amount of this deposit. Then we may have or we may not have some grace period for rent payments. So if we do have, we can specify the amount of months for rent holidays here. Then we specify when we get the first revenue. So here we specify the year and month, and you have to think of all these parameters. So just revise your business idea and think what is the square footage of your business idea, what is the duration of the investment stage, how many months it will take you to get the first revenue. When you're planning to get the first revenue, month and year, just start thinking about it. Then we start specifying the investment stage expenses. So here we specify what we invest in, then we specify how much we invest in during the timeline. So we start operating activity in July. Here is July, and before July we have 2 months investment stage. So for example, if we start operating activity in August, yep, so here we see August, all our project automatically displays to the start of operating activity, displays to August. If for example the investment stage duration will take 3 months, we can see here additional month of inputs colored with blue. So this is very important. The automation of financial model is very important because when you automate data flows, this decreases the amount of mistakes that you make, and then you can calculate more accurately the amount of money you need, the payback period, revenues, profitability, profit, and so on. So this is very important, so that's why I'm talking about it. So then we specify, moving forward, we move to the customer. So if you have a business idea, you have to think about what types of customers do you have. So they are not the same. So here you can create the portraits of your customers. You can name each portrait of your customer. Here we can switch on and off different portraits from calculations to see what will be simple, discounted payback period, what will happen if we switch on and off this or that portrait of customers, because for example we may be too optimistic with this type of customer, and we for example want to know if we switch off this optimistic type of customer, what will happen to our project then. And this is very interesting when your cash flow is done, when you are done with the model. People always want to play with all this stuff because now they finally have an opportunity to get acquainted with their business ideas. So this is very important. When the project is done, when all inputs are in, so then we specify for each type of customer the average check. Then we also have the coefficients to play with these average checks. So for example, we don't want to play with these numbers. We just want to know what will happen to the cash flow statement if we increase, for example, the average check for the customer type number 2 on 20%. So this is base value, actual value. So, and we can go to simple and discounted payback period, see that how this affects the diagram, and we can see how this type of customer affects generally the picture of your cash flow, net present value, and other financials. So then we specify in percentages what are the direct expenses inside the average check. So then we specify the level of direct expenses inside the average check. We also have the same coefficient for direct expenses. So for example, if so 30% of this average check is $24, and if we for example increase the amount of direct expenses, for example on 30% for the customer number 1, this will be not $24 but $31. And we can quickly look at simple and discounted payback period time and see what will happen to the project. So playing with coefficients is very important, and adding coefficients is very important for scenario analysis, which will occur many steps ahead when you will start looking at your project, when you start creating scenarios, analyzing how stable your business idea is, and you won't be working with the values themselves of inputs like this. So you will be, first of all, you will be working with coefficients, because you just need to know how much the revenue can increase, how much expenses can rise to give you a minimum of a profit. So you will be playing 100%, you will be playing with coefficients. Then we move to so here we have the amount of customers coefficient, and then we also have the timing parameters. So the different types of customers won't stay with us forever. So one type of customer, one portrait, can stay with us, for example, for the period of 4 months, or for example he just can make just one purchase and disappear. So that's why, so we have to, and you have to think about your customers. What types of customers do you have? Try to think that they are not all the same, because when you start assigning the duration of their life cycle, you will be able to see your project from a new different position, because you will get you will be able to calculate your revenues more accurately, because maybe you are too optimistic with your revenues that you are now thinking of. So that's why you specify how much time does each type of customer stays with our project. And we also have the coefficients for these life cycles. Then we move and specify how many new customers join our project during the first 6 months of our operating activity, and then we extrapolate these numbers. So we specify the amount of customers, so we can switch on and off different customers. For example, when we are done with cash flow, so we can just switch off this type of customer. For example, we can go to the cash flow, to the simple and discounted payback period diagram, and see how this type of customer affects simple discounted payback period. We can also, for example, go here, switch off this type of customer, then we can go back. We need just to wait a little bit and see how this type of customer affects simple and discounted payback period, cash flow, the amount of money we need. So we can quickly play with huge amount of data if we create the coefficients, on-off buttons, and so on. Then we have a coefficient to play with all when we want to play with all the amount of new customers. So here we specify the values, but we can also, for example, say what will happen to our business ID if we have only 20% of the amount of customers that we assumed here. And we can go to the simple and discounted payback period and look at what will happen if we have only 20% of customers that we've just specified. So, and we can quickly see if our business idea is profitable in this case or not. And when people play with this coefficient, they finally start getting acquainted with their business idea. What is the real revenue? What is the real profit? What is the real financing needed. Then we can also play with the amount of checks that this or that type of customer gives us monthly. So we have 5 types of customers, 5 portraits of customers. We've already specified that the duration of life cycle for customer type number 1 is 4 months. Then for the next one is 8, then 12, and so on. So here are the durations of the life cycle. Then we need to specify how often inside this life cycle this customer purchases our product or our service. And this means that this customer, this type of customer, purchases twice a month during its life cycle. This one purchases 3 times, 4, 5, and 7. So we can, inside this life cycle, we can specify any customer behavior. For example, he can purchase once, then 2, then 3, 4, then 3, 2, 1, 1, and then he will disappear. So we can create absolutely different customer behavior inside the life cycle for different types of customers. This is very valuable for revenues calculation, for the revenue generating algorithm that we will be building. So this affects the level of detail of your business idea. This will persuade you to start the business because you will be absolutely confident about the numbers you will get at the end of your calculations. Your business partners, so your business partners will see that you're serious about the way you calculate. And this group of coefficients, so we can play with specific customer behavior for this or that portrait of customer, and we have general coefficient for amount of purchases for all types of customers. So if we don't need to play with specific type of customer, we can play with all of them just using this coefficient. But if we want to play with specific, we can use specific coefficient. So this is important as usually for scenario modeling. Then we move to advertising. So at the beginning of operating activity, we have different advertising expenses, and we specify what we invest in during the advertising campaign and when we spend this month. So this is the cost allocation for advertising expenses during the first 36 months of operating activity. Then we move to marketing, advertising, direct expenses. So this block is also very important because, for example, we have different sources of customers for YouTube, Instagram, TikTok, and so on. So for example, we have different source of customers. Then we also have coefficients for the cost of one customer from different sources. So this coefficient is general for all direct marketing and advertising expenses, and these coefficients are specific for advertising expenses for each for this or that specific source of customers. Then what we do after, so when here we have the operating activity months, and here from left to the right, so we can see the names of sources from which the customers come to our project, and we allocate 100% of our customers through all these sources. And the structure of allocation may be different. So for example, during the first period, the allocation can have structure number 1. Then for example, after a year, the structure may change. So that's why we have the structure in dynamics during the whole operating activity. So this is very important, because this will allow you to calculate marketing and advertising direct costs more accurately. Then we specify what is the cost of one customer from this or that source. So for example, at the beginning, the cost of one customer will be 1. Then after some period of time, the cost of one customer from this or that source maybe can differ, can change. And here we can specify if these values will change. We can specify the cost of one customer in dynamics. So this will allow you to calculate your marketing and advertising expenses more accurately. And of course, you can play after you've specified all this data. You can play with coefficients and say, for example, what will happen to the business if the marketing and advertising campaign will grow, for example, 4 times. What will be? So you just do this, go to the diagram, and see. Just give Microsoft Excel a second to calculate all this data on, and see how this affects the simple discounted payback period, then cash flow statement, and so on. So, and this is also is very helpful when you are building different scenarios for your business partners and so on. So then we are moving, when we describe direct marketing and advertising expenses, we are moving to direct payroll. So this payroll depends on how many customers do we have at the moment. So here we specify the person, the position that we need. Then we specify the salary of one person on this position, and then we specify how many customers, the metrics, how many customers per one person on this position. So the ratio, how many customers per one person on this position, and that's why we are not specifying here the amount of people we need, because we will calculate the amount of people needed according to the amount of customers. So here we just specify the metrics. So we need, for example, one person on this position per 900 customers. And then if we have, for example, less than 900 customers, we will have one person on this position. If we have, for example, 903 customers, we will have 2 people on this position, and the payroll, direct payroll, will be calculated automatically. So this is a very valuable thing. So it is vital for the projects like this. Then we have another type of payroll which is stable, and this payroll doesn't grow or decrease if revenue increases or revenue decreases. So for example, this is like chief accountant, chief executive officer, office manager, and so on. So these are the this is not a direct payroll. This is a stable payroll, which doesn't increase or decrease when revenues increase or revenue decrease. So this is a stable story. Here we specify the positions inside the stable payroll, what is the salary of one person on each position, and how many people on each position do we have. Then we may also have some block of direct expenses per one customer. So for example, we may have, so here we can name all the direct expenses. Then we specify the level of expense per one customer per month for this expense item. We can, for example, switch on and off this direct expense item to see what will be the cash flow, a simple and discounted payback period with or without this or that expense. Here we have coefficients for these expenses to make us easily play with scenarios. So this group of expenses are linked to the amount of customers that we have at any given moment. So as you can see, your business idea, so we have different types of direct expenses. So let's, for example, go back and see the first group of direct expenses. They live inside the average check. So this, for example, if you sell chairs and you buy chairs, then these direct expenses are the here you will be just specifying the price that you will be paying when you buy the chair, and this is your selling price. This will be a selling price. This is the first direct expense. These are linked to the amount of chairs that you sell. Another group of direct expenses, so there are multiple groups of direct expenses. So other group of direct expenses, they are linked to the amount of, not the amount of chairs that we say, but the amount of customers that you have in any given moment. So this is another story. Then another group of direct expenses is linked to the amount of new customers, not customers at any given moment, all of customers, but new customers, because we are talking about marketing and advertising. So, and when you have a business idea, you have to think what parameter you have to link this or that expense, and this is very important when you have some business idea, because if you link wrong, you will calculate this or that expense the wrong way, and you will make a mistake. You will see you will calculate the wrong revenues, direct expenses, profits, and so on, money you need to start the business, and so on. Then in our business idea, we may have some fixed expenses, but they may have some seasonality. So that's why we create a typical year. Here we have the names of these expense articles, and then we specify the payments inside the typical year for this or that fixed cost item. We can also switch them on and off to see what will be the performance of business with or without this or that expense. We also have coefficients, and then we need to move and describe how customers will pay us, because we need to describe it, because if we ignore this block of inputs, we will 100% calculate the amount of financing wrong way. So we have in our business idea, and you have in your business idea, different types of customers. So we will already describe them from perspective of average check, life cycle, and so on. But for example, 20% of people who represent customer type number 1 will pay you today. So you will sell them today, and they will pay you today all the revenues. Then 30% of customer type number 1 guys, you will sell them today, but they will pay you next month. This means that they will pay you next month, that you may face losses this month because the revenue will come next month. And for example, 10% of customer type number 1, you will sell them today, but they will pay you 2 months later. And this will affect the amount of money you need to start the business. And here you describe, in this block of input, you describe, so here you allocate the revenues between these types of customers. So type customer number 1 have 5 types of payments. So you allocate customer type 1 money. Then you describe how these people pay us. So this person pays us in momently, this person pays us next month, and so on. And then we describe the way people pay us, and then all these algorithms, this data flows to cash flow statement and show us the operating losses that we will have to finance. And these operating losses added to the investment stage expenses will form the total amount of money that you need to start the business. And when you clearly, if you accurately specify the way that people will pay you, you will be able to see more accurately what is the real amount of financing you will need to start. So then if you have a loan, you can specify the amount of money that you take as a loan, the long term, how many months, then the interest rate, if there are any grace periods for payments, for principal payments, for interest payments. Then you can also specify when you take the loan, year and month. Then you specify the level of the rates of taxes, asset tax, monthly payment, and then all your story comes to the cash flow statement. So here is the most important table for all your business idea. So here you can see how many money you need to see to start the business, what is the structure of your business or financing that you need, then how you eat this money. So for example, you can look at cash balance at the end of the period and see how at first period you are eating the money, then you have 0, and then from this moment the project starts generating its own cash. And remember that we talked about the way that people, our customers, pay us, this block of inputs. This block sufficiently affects these operating losses during first several months of operating activity. And when you accurately specify the behavior of the customer behavior, you will be able to see more accurately the amount of operating losses that you will have to finance during first several months of your business, when your business starts. Because when you start your business, your expenses will be at maximum, your revenues will be at minimum, and you will have operating losses like this, and you will have to finance all these losses. So this is a very important thing that I have to tell you about. Then, so here you can see how the business breathes itself. You can look at the result of operating activity. Then you can also look at cash balance at the end of the period and see what is the amount of cash generated cumulatively at any given moment inside the timeline of your business idea. So this is a very important thing to look at, to see how your project breathes inside the timeline. So here you can see the structure of financing. You can, for example, say that so you will be taking not $2 million loan, but for example $15 million loan. So you can, for example, change the values. You will see that the structure of financing changed. You can go to the cash flow statement and see. So here we have the 0, and this is the moment when the project starts generating its own cash. All the simple and discounted period diagrams recalculated. So this is very important for scenario modeling. So each time, so the reality is the following. So the business owner starts adjusting the data here. Then he's looking at simple and discounted payback period. He's looking at financial efficiency, which is here, simple, discounted payback period, net income, net present value, internal rate of return, total financing needed. Then he starts adjusting the inputs, playing with coefficients. Then he is looking at the cash flow statement, looking at what is the operating profit in absolute numbers, what are the revenues in absolute number. So so this is the ordinary road of business starter, or how he moves inside financial. What are the moves are made by him inside financial models. So first of all, the basic scenario is made. Then some adjustments are taken place. The business owner looks at simple, discounted payback period, looks at financials, looks at the cash flow statement, what are the revenues, what are the profits, what is the cash balance generated by this or that moment inside the timeline. So then the next tab is the tab where we specify the level of discount. Then we specify the step of change of discount rate to calculate the internal rate of return. And then here we have a stress test sensitivity analysis tab. So we can, for example, we can do like this, for example, and we would like to know how stable our business idea, for example. So if we take what we would like to test, for example, direct expenses. let's go to the cash flow statement and see what types of expenses are critical for the business idea. So for example, direct expenses, customer. Okay, so for example, customer type number 5, direct expenses. So we can go, for example, we can go to customer, we can go up. Here we have direct expenses, customer type number 5, and we can add here a coefficient for sensitivity analysis. So here we have this coefficient, then we press enter, and now we can test how the financial efficiency will change if direct expenses for customer type number 5 will rise or decrease. Then I go to sensitivity analysis tab and press enter and see what will happen. So here we can see what will happen to our business idea if these expenses will rise or decrease, what will happen with total financing needed, what will happen to simple, discounted payback period, and so on. Now, for example, we will remove this coefficient from this value, for example, and we can go and see what will happen to our business idea if we increase, for example, the amount of investment, for example, for equipment. I don't know, but there is a specific investment item which will seriously play part in our business idea, and we would like to know what will happen if this specific expense line will grow or decrease. So I will add this coefficient to this line, to this parameter, to this input, press enter. So now this coefficient is added. Then I go back to sensitivity analysis and then press sense button and see what will happen. So this is a very good instrument also for testing your business idea. So you can add this coefficient to any input data in blue cells, press sense button and see how these or that parameter of inputs affects cash flow, affects your financial efficiency, main numbers. So this is a very valuable instrument, stress testing to getting acquainted with your business idea finally, because you may know nothing about your business idea until you start playing with all this stuff that I'm showing you. I hope that you enjoyed this video. I was trying to create some structure inside your thoughts. Maybe you have a business idea and you don't know how to start, what to start with. That's why I decided to make this final overview of this model and show generally what parameters may affect financial efficiency of your business idea, and in what ways this specific model can help you. I will be giving you all the links on the creation of this model in the description of this video. So stay tuned. Next time we will be starting a new financial model. So see you guys in next videos. Thank you and bye.